Hello and welcome to the 15-minute quarter. My name's Nick Brown. We considered maybe doing this one like the 15-second quarter because there's not a whole lot of good news to talk about from a market perspective. But that felt like it would be a little bit of a cop-out. So for those of you that have watched this before, this is our quarterly market update where we provide some news, some headlines, some things that happened in the market over the last 90 days. Give our perspective on them and hopefully provide our clients, their friends, their family with some actionable information that they're able to use moving forward. So without further ado, we're going to get right into it. This one we're calling the R word because that's a word that we've heard a lot over the past 90 days is recession. So we're going to speak a little bit about what that means, what it means for the economy, what it means for the market, and what it means for market participants, investors like yourself. So as always, want to get the legal stuff out of the way first. This is for informational purposes only. It's not meant to be customized investment advice. We don't provide investment advice without a written agreement in place. We're going to talk about some performance numbers. Those performance numbers are not going to be that great, but those performance numbers do possibly represent an opportunity. But the key thing about those numbers is, hey, a lot of the portfolios we're talking about are going to be hypothetical, not meant to represent or replicate an actual portfolio. We try to be accurate. We believe all of our data sources are accurate at the time of publication. But if there's one thing that is certain in life, it's that nothing is certain in life. And so we like to kind of add that at the front end of every conversation. So let's get right into it. This quarter was, for all intents and purposes, a pretty rough quarter, whether you were watching the news or watching your investment portfolio, because we kind of followed a cause and effect pattern where, hey, inflation was really high. In fact, we just got the latest inflation read for June at 9.1%. So I don't think that's a big secret. We've talked about it since March of 2021, and probably every single quarterly update since then. We'll continue to talk about it now, but last quarter, inflation ran really hot. So the Fed does what the Fed does, which is raise interest rates to try and address inflation. And when you raise interest rates to address inflation, the economy cools off. And we saw all of that in the last 90 days. We saw the Fed raise interest rates by 75 basis points, one of the greatest interest rate raises they've had in close to 20 years. And as a direct result, we saw bonds take a hit. We saw housing start to slow down, and we saw a drop in GDP. So what does that mean? And when we talk about, hey, are we in a recession? How do all these things factor in? Because that's a term that's starting to get tossed around in the media. And frankly, in some of the conversations we have with our clients, are we in a recession? And so I wanted to spend a little bit of time defining that word and talking about what it really means, because the working definition is, hey, 2+ quarters of negative GDP growth. Well, we already had one. If you remember that previous slide, one of those red boxes talked about the fact that in the US, GDP growth was about negative 1.5%. And so if we get another quarter, and we won't know that until the end of July, we won't have an advanced reading for another couple of weeks, but we would fit the working definition of a recession. Now, the goalpost has changed a little bit. The National Bureau of Economic Research, they're the ones who actually get to declare recessions. And so they don't just take GDP growth into account. They take things like unemployment, output, market declines, general economic activity and attitude to determine, hey, are we in a recession or not? And so here's some good news. There are some conflicting data points. If you're looking at the stock market, we're looking pretty recessionary. If you're looking at GDP, we're looking pretty recessionary. If you look at unemployment data, we have a pretty strong labor market. Unemployment is at historic lows. Continuing claims are at historic lows. We're looking pretty good. If you look at wage growth has been ticking up over the last couple of months. We're looking pretty good. So there's some confusing input, some confusing data points when it comes to whether or not we are in a recession. But that being said, we still got to deal with the market environment that we're in. So one of my goals is to make sure that the people who watch this video walk away with at least some sort of information they can use when it comes to working and investing in the market. So let's talk about what's happened in the past. All right. Q2 was not fun if you were an investor, whether you were an equity investor or a bond investor. Everything across the board is red, due in large part to those headlines that we talked about. And so in the equity markets in the US, in real estate, we saw about negative 16, 17%. In international and emerging markets, a little bit better, mainly as a function of currency translation, but still negative 14 and 11%. This is a good time to talk about the importance of diversification. The US is a significant part of the global economy, represents a little bit over 50% of the investable universe, but it's not 100% of the investable universe. And so one of the things that our firm strongly believes in is in diversification and allocating capital across the globe, not just in the US. And this is one of the reasons why we want to do that, is because, hey, emerging markets or international markets, they do provide some diversification benefit to our portfolios, even if that performance is still negative. On the bond side, we saw a continuing trend from Q1. Q1 was the worst quarter on record, going all the way back to 2001 for bonds. And this is a close second. And we talked a lot in our Q1 update about, hey, I'm in this environment where stocks are negative and bonds are negative. What's an investor to do? We'll remind and review that a little bit later on in the presentation. Just know these numbers, these are all bonds. If we shoved every bond into a big bucket and said, what was the average based on their proportional value in the market, these are the numbers we would get, about negative 4.7 in the US and negative 4 internationally. But not all bonds are created equal. And most investors don't own every bond in its proportionate amount. So we'll talk about some things that you can do, or that we can do, to help kind of mitigate the risks that are associated with bonds. Because when we're in a rising interest rate environment, we've already talked about, hey, cause and effect. The Fed's got a playbook. Inflation goes up, they raise interest rates goes up. Well, guess what? Bonds, the secondary value, they're going to go down. And there are some things that we can do to help address that. We call that interest rate risk. And one of the things when we talk about bonds is, hey, we want to mitigate risk because they're there to act as an anchor to a portfolio. But want to set the Q2 economic stage kind of in context and actually talk about, how do we navigate this? How do we get through this? So let's talk about investing in this kind of confusing and inflationary market. We put out an article back in, I want to say June of 2021 that specifically talks about investing in an inflationary market like we're in right now. And one of the key considerations is making sure we get the big things right. What do I mean by the big things? We want to make sure that we've got our asset allocation appropriate for our situation. Okay, so if you're maybe a retired investor that needs to live on their portfolio, your asset allocation is going to look different than a 30-year-old investor who's got his entire career ahead of him. And we want to make sure that investors' portfolios are lined up with their circumstances. So that's one of the first and most important things that we can do going into this inflationary environment, because we don't want to have too much of really anything, too much cash and we get hurt from inflation, too much equity and we get hurt from volatility, too many bonds or not the right bonds and we get hurt from interest rate risk. So getting the big things right is the first and most important factor when we're in this type of environment. The next is making sure that we own the right things. When we talk about equities, we want to own equities that have a little bit of a tilt towards what scientists call the fama French factors. That's really just a fancy way of saying, hey, I want my equities tilted a little bit towards value and size. Research has indicated that we get a little bit of a pickup, and it especially helps in inflationary markets when we tilt our portfolios, kind of like an ice cube tray, towards those factors. And then the last one is when we're in this rising interest rate environment, we want to focus on bonds that are going to have shorter durations and high credit quality. That way we can kind of dampen some of that volatility that we're seeing in the bond market. And there's one asset class that I haven't talked about, and it comes up a lot. It's gold. What about gold? And I wanted to throw up kind of an interesting little back test on adding gold to a portfolio. So these numbers are hypothetical. They're not meant to, like I said, not meant to represent an actual portfolio. But we've got 3 portfolios in front of you. One that has no gold, 60% stocks, 40% bonds. Another one where we took 10% of the stocks and turned it into gold. And the third where we took 10% of our bonds and turned it into gold. And you can see the portfolio that's 60% stocks, 40% bonds, or 60% stocks, 30% bonds, 10% gold, they perform about the same over that entire, almost 25-year time period. At the end of the day, your rate of return was almost the same. If you started with $10,000, you almost to the dollar, about $300 off, ended up with the same amount of money. So we don't really get a pickup adding gold, but what thing we do is we reduce our bond exposure and we reduce the income producing capability of the portfolio. I want to highlight one thing though. If we take the gold away from stocks, we actually do get what we call a higher risk adjusted rate of return. We pick up about 0.5 percentage point on risk adjusted rate of return, but the actual total return of the portfolio is almost $30,000 less. That's because we took this long-term capital asset and turned it into a more speculative asset. And so our belief is that rather than owning a speculative asset, it's let's just make a good mixture of stocks and bonds, and we can erase kind of that downside drag. One final note on bonds, because we just talked about, hey, rather than using gold, let's just make sure we get the bonds right. When we're in this rising interest rate environment, you can see long bonds. Those are the bonds that are kind of at the bottom of the screen. These are bonds that don't come due for another 5, 10, 20, 30 years. That's where a lot of the negative performance is. Whereas bonds that are on the short end, that's where we're getting some of that dampening, that anchor to the portfolio. And so that's one thing for investors to consider, especially when they're going into a rising interest rate environment, is, hey, what types of bonds do I own and where? Finally, we always like to end with, hey, what does the total portfolio look like? You know, most people don't have 100% stocks or 100% bonds. So when you're looking at your statements and you're trying to determine, hey, what should I have done in the quarter? Here's some general benchmarks. 100% equity portfolio be down close to 16% year to date. Now, here's an interesting note. We actually kind of are a little unfair to ourselves when we put these numbers up, because when we say bonds, what we're using is the 90-day T-bill, which was flat. It's actually positive. It's one of the only positive bonds that you could find in the market. And that's what we're using in this 80-20, 60-40, 40-60 portfolio. Almost no one is going to be invested in just 90-day T-bills. Most of these portfolios are going to have bonds that had some negative downward pressure. And so what we see in the market is for that 80-20 portfolio, that 60-40 portfolio, you can almost add another -4% to these numbers, another -2 to 4% to these numbers to come up with a pretty accurate gauge of where a portfolio should be year to date. So hopefully you guys found this information helpful. Again, my name's Nick. I'm one of the partners here at Granite Harbor Advisors. If you have any questions about this presentation or would like to discuss your specific situation in more detail, please feel free to reach out to us via any means you are most comfortable with. We've got our website, we've got our phone number. There's a carrier pigeon that you could probably send our way and get it to us, but really appreciate your time and thanks for watching.